What is up, future CPAs? Look, if you're an accounting student prepping for the board exams, you already know how heavy taxation can get. It's a lot. But hey, don't stress, because this explainer is basically your ultimate cheat code for mastering the fundamentals of Philippine excise tax. We're skipping the dense textbook reading today and giving you the exact brain-friendly visual frameworks you need to totally crush Quiz 1. So here's the real question we gotta ask. Do you just want to scrape by and pass your upcoming quiz? Or do you actually want to lock down these excise tax rules so firmly in your brain that you literally still remember them 3 years from now during the actual LECPA? By understanding how these rules work in the real world, instead of just blindly memorizing them, we're going to build a mental foundation that actually lasts. Okay, so here's our game plan for today's explainer. 1. The excise tax mindset. 2. Timing and location rules. 3. Specific versus ad valorem. 4. The GSP markup rule. 5. Export credits and refunds. And finally, 6. A rapid bullet review.
Let's dive right into part 1, the excise tax mindset.
All right, let's really break down this definition from the tax code. Excise tax is a national indirect tax. That means it's imposed by the national government, sure, and the burden can actually be shifted to the final consumer. But you've got to look closely at the trigger here. It's imposed on goods manufactured or produced in the Philippines, and also on things imported. And here's the absolute kicker for your board exams. It's applied in addition to the value-added tax. Think about a locally manufactured pack of cigarettes, right? It gets hit with excise tax because it's an excisable good produced here, and then it gets hit again with VAT when it's sold. They are not mutually exclusive. They literally exist at the exact same time on excisable goods. So, the absolute most crucial thing to remember is that production is the trigger, not just the sale. If you're studying VAT, you know you're usually waiting for a sale, barter, or exchange to happen before there's an output VAT liability, right? But for excise tax, no way. The mere act of manufacturing is an excisable event. Examiners absolutely love to trick you with this. They'll give you this whole scenario where goods sit unsold for a year and then ask for the tax liability. Remember, production triggers it. Even if those goods are just gathering dust in a warehouse and haven't even seen a customer yet, that tax liability has already... Moving on to part 2. Timing and location rules. So ask yourself this. If I manufacture a taxable good today, but I don't end up selling it for another 6 months, when exactly is that excise tax due to the government? The answer to this is honestly one of the most highly tested concepts on the board exams. It's all about these strict physical anchors. For domestic goods, the tax absolutely must be paid before removal from the place of production. You gotta visualize a literal physical gate at the factory. Those goods cannot cross that gate until the BIR gets paid. You can't let that product leave the factory doors until the tax is totally settled. For imported excisable goods, the rule is pretty parallel. The tax has to be paid before release from customs custody. It is all about that physical border. Once it crosses that threshold, bam, the tax must be paid. All right, part 3, specific versus ad valorem. Let's keep this incredibly simple. Every excisable good falls into one of these two main categories. Imagine you're taxing a liter of a sweetened beverage. If you're taxing it based on how many liters are actually in the bottle, that's a specific tax. It relies entirely on a physical unit of measurement, weight, volume, or capacity. But on the flip side, if you're taxing a brand new imported SUV based on the massive price tag sitting on the dashboard, well, that is an ad valorem tax. It's based strictly on the selling price or monetary value. To instantly distinguish these two on a tricky multiple choice question, just use this mental anchor. Specific equals space or size. Ad valorem equals value. If a problem gives you a tax rate of, say, 12 pesos per liter, your brain should immediately yell specific. If the problem gives you a tax rate of 20% of the gross selling price, your brain needs to yell ad valorem. Which brings us to part 4, the GSP markup rule. I want you to think like a tax examiner for just a second here. If an ad valorem tax is a percentage of your selling price, what is stopping some sneaky manufacturer from artificially lowering their selling price? Maybe even selling at a massive loss to a sister company just to avoid paying a huge excise tax. Well, the BIR is way ahead of them. First things first, we have to establish the base, the gross selling price, or GSP. By default, strictly excludes the value-added tax. When you're computing the ad valorem tax base, that VAT has got to be stripped out first. If a board exam problem hands you a VAT-inclusive selling price, your very first move must be dividing by 1.12 to strip the VAT right out of there. If you compute excise tax on a VAT-inclusive base, yeah, your answer will probably be sitting right there in the multiple choices, but it will be 100% wrong. You calculate the excise tax based on the VAT-exclusive amount. Now, later on, that excise tax actually forms part of the base when you compute the VAT, but back to our sneaky manufacturer. If they try to sell below cost, bam, the BIR steps right in. Specifically, if that selling price is less than the cost of manufacture plus expenses, the BIR mandates a minimum 10% markup on those costs and expenses to build an artificial tax base. The law literally commands that a proportionate margin of profit, not less than 10% of the manufacturing costs and expenses, has to be added to constitute the gross selling price. The BIR basically artificially inflates the tax base to completely shut down that tax avoidance. Do not forget that 10% threshold.
Next up, Part 5, Export Credits and Refunds.
Let's see how this builds into a linear, real-world process for businesses. So, according to the destination principle, goods are taxed where they are actually consumed. Because we only want to tax local consumption here in the Philippines, the BIR will refund you if the goods go abroad. But wait, remember our timing rule from earlier? The tax was already paid before the goods even left the factory? So to fix this, the law provides a really clear refund mechanism. Step 1, you locally produce the goods and pay the tax. Step 2, you actually export them without them ever returning to the Philippines, and obviously you submit proof of that. Step 3, you receive the corresponding foreign exchange payment. If you meet all 3 of those, you get your credit or refund. Now, this perfectly illustrates the exception to the rule, which is exactly what board examiners love to test. For general exported goods, yes, absolutely, the excise tax is credited or refunded. But for mineral products, there is 0 refund and 0 credit, even if those mineral products are legitimately exported. Unless it is coal or coke. General goods, refunded. Mineral products, no refund unless it's coal or coke. You definitely want to burn this rule into your brain.
Finally, Part 6, the LECPA Rapid Bullet Review.
Okay, take a mental screenshot right now. Here are your 5 core truths to totally lock down quiz 1. First, excise tax is national and indirect, and it hits simultaneously with VAT. Second, the trigger is always production, and it's due before removal from the factory or release from customs. Third, classify the math. Specific is physical space, ad valorem is value. Fourth, the GSP strictly excludes that, and if you sell below cost, the BIR forces that mandatory 10% minimum markup. And finally, exports generally get refunded based on the destination principle, but you've got to watch out for that tricky mineral products exception. So you've got the ultimate cheat code now, and these foundational rules are hardwired into your memory. You actually understand the why behind the tax. But look, knowing the rules is only half the battle. The real question is, can you apply these hacks to actual multi-step computation problems when the clock is ticking during the board exams? Keep practicing, keep applying these mental anchors, and you are going to be unstoppable. Thanks for joining this explainer, and keep grinding.